In July of 2012, a small startup called Oculus took the world of video gaming by storm when they unveiled their prototype of their virtual reality headset at the E3 Expo. Shortly thereafter, Oculus set up a Kickstarter campaign where people all over the world could help fund its development. If you donated more than $300, you'd be sent an Oculus prototype. The Kickstarter was a huge success, raising $2.4 million from almost 10,000 donors. Just 2 years later, Facebook acquired Oculus for $2 billion. Had the crowdfunding been an equity raise, assuming Oculus sold just 10% of the company, the contributors would have made a 100-fold gain on their investments. But the Kickstarter campaign wasn't an equity raise, so when Facebook acquired Oculus, the contributors received nothing. Up until recently, government regulations made it illegal for individual investors to invest in private startups. Only wealthy, so-called accredited investors could invest in companies before they IPO'd. Many people viewed this as unfair. Venture capital firms were able to invest in innovative tech companies in their early days at tiny valuations. In some cases, these startups generated astronomical returns. Ordinary investors could only invest once a company goes public. At this point, the valuation is much higher, so the chance of life-changing gains going forward is limited. This all changed in 2016 when the SEC revised regulations around equity crowdfunding. Now, ordinary investors could finally participate in early-stage venture investing. Since then, there's been an explosion of equity crowdfunding platforms geared towards small-time investors. To date, they have raised billions of dollars. While the idea of investing in early-stage startups might sound exciting, there are significant risks involved. In this video, we'll take a deep dive into the realm of equity crowdfunding and why it's probably not a good idea for the vast majority of investors. This video was brought to you by Bellroy, an Australian brand which makes some of the highest quality personal accessories I've ever tried. As a YouTuber, I have the benefit of being able to work from anywhere, so having good, lightweight travel gear is a must. I use their light day pack, which is really good for hiking or just traveling anywhere. The first thing you'll notice is how light it is, and when you need to store it, you can roll it up into a compact roll that takes up very little space. While the front is water resistant, the back and straps are padded and breathable, which makes it way more comfortable when you're carrying a lot of weight. Inside the backpack, there are internal pockets to hold your laptop, phone, water bottles, etc. Here, I'm also packing my Bellroy Tech Kit, which is great to carry your hardware. I'm super impressed with this backpack. In addition to making great products, Bellroy is also focused on minimizing their environmental footprint. This day pack is made from 100% recycled PET plastic bottles. The recycled materials perform just as well as virgin materials, but are obviously way better for the environment. So if you're looking for a new backpack or a whole host of other urban minimalist accessories, make sure to click our link in the description to get 10% off anything on bellroy.com. And now back to the video. Prior to the 1930s, there were substantially no investment regulations. Anybody could offer whatever investment security they wanted. Anybody could buy these securities so long as they had the money to pay. This unregulated environment laid the groundwork for a boom in both the public and private markets during the Roaring '20s. But it also allowed a huge number of financial frauds and bad investments, which contributed to the Great Depression in the 1930s. In response, the federal government passed a number of new laws establishing the SEC and creating a comprehensive set of standardized disclosures issuers are required to submit when they sell securities to the public. While this greatly reduced the amount of fraud, it added a huge administrative burden for legitimate businesses. These days, even a small publicly traded company typically spends at least $1 million per year on auditors, lawyers, etc. to comply with applicable regulations. This made it very difficult for small businesses to raise equity capital from the public, as the costs of being a public company are prohibitive. In the 1980s, a compromise between financial liberalization and investor protection was reached with Regulation D. Under Regulation D, companies can raise equity capital without registering with the SEC, so long as they only raise money from accredited investors. Accredited investors are people who exceed certain wealth requirements. The thresholds have changed over time. Currently, you need to have a net worth of at least $1 million excluding your primary residence, or make at least $200,000 per year. The idea is that rich people are more likely to be sophisticated investors. They're better equipped to do due diligence on their investments, even without standardized SEC disclosures. And even if a wealthy investor does end up investing in a fraudulent company, the losses are less likely to leave them financially ruined. In 2012, the Obama administration signed the so-called Jobs Act, which allowed startups to raise capital from non-accredited investors. This laid the groundwork for equity crowdfunding. While the Jobs Act was passed in 2012, it took the SEC 4 years to finalize the regulations in 2016. The regulations were further relaxed in 2020, which is when the boom in equity crowdfunding really started to take off. Under regulation crowdfunding, startups can raise up to $5 million in a 12-month period from non-accredited investors. There are some standardized disclosures they have to provide, but it's a tiny fraction of what is required in a traditional IPO. So now, for the first time since the 1920s, individual investors with just a few $100s can try their hand at venture capital investing. While this may sound like a great opportunity, investors need to be aware of a few significant risks before they even think about getting involved in this market. The first thing you have to know about venture investing is that most startups fail. Sometimes they're unable to complete development of their product. Sometimes they develop their product, but demand for it is far less than expected. Sometimes a startup makes fraudulent misrepresentations about its technology. Even for experienced investors, the majority of venture investments are failures. For example, Shark Tank co-host Barbara Corcoran says that she loses money on 90% of her Shark Tank investments. With that being said, high failure rates alone is not a reason to avoid venture capital. Even if 90% of your investments fail, the 10% that succeed might make huge gains that offset your losses. Thus, even with a low success rate, your expected value may be positive. Volatility isn't the biggest risk with venture investing. There's a much more fundamental problem. In 1971, the economist George Akerlof published a paper called The Market for Lemons: Quality, Uncertainty, and the Market Mechanism. This paper eventually won him the Nobel Prize. The paper focused on the example of used car dealerships. The quality of used cars is highly variable. Some used cars are in pretty good condition, and you could drive them for another 10 years. Other used cars have serious mechanical issues and will break down within just a few months. Poor quality used cars are often colloquially referred to as lemons, which is where the name of the paper came from. Many used car buyers are unsophisticated in that they don't have the mechanical expertise to inspect the car. When they buy a used car, they're taking a gamble, kind of like how a venture capitalist takes a gamble when investing in an unproven startup. As a buyer, a good quality used car is worth $15,000 to you. A poor quality car will quickly break down and need $10,000 worth of repairs. Thus, you'd only be willing to pay $5,000 for it. Assuming half of used cars are good and half are bad, the expected value of the used car is $10,000. The problem is, if you're a seller with a used car that you know is good, you'd only be willing to sell it for $15,000. You wouldn't be willing to sell it for the market price of $10,000. The only people willing to sell their cars are people who know they are of poor quality. Thus, only low quality cars are ever sold. The high quality used cars are never sold. The solution to this problem is to hire a mechanic who can inspect the car and determine whether it's good or bad. If you can confirm that the car is of high quality, you can afford to pay a fair price and the seller will be willing to sell. Venture capital funds are like the mechanics. They conduct due diligence to judge whether a startup is good or bad quality. Of course, VC firms aren't perfect and they often end up investing in fraudulent companies. But at least in theory, their chances of investing in a fraud should be far less than an individual investor who doesn't have the resources or expertise to conduct due diligence. Financial markets are no different than the used car market. Some companies are good, and some companies are bad. Good companies welcome a rigorous due diligence process. Once a venture capitalist confirms they're legit, they'll be rewarded with a larger funding round at a higher valuation. We can see a similar dynamic in the public markets. Companies that go public via SPAC tend to have significantly worse returns than those that use traditional IPOs. This is also due to self-selection. Fraudulent or low-quality businesses are more likely to opt for SPACs to avoid the rigorous due diligence process of traditional IPOs. In our recent video about Kevin O'Leary, we point out many of his business failures. One of his business ventures is a retail stock brokerage called Beanstox. Beanstox is a super simple investing app targeted at unsophisticated investors. You answer a few questions about your investment goals and risk tolerance. They have an automated system which will recommend a portfolio of passive ETFs. You can set recurring deposits from your bank account to invest every month. There's a free version where you can only invest in a short-term treasury ETF or a broad US stock market ETF. If you pay $5 per month, you can get access to the Wealth Builder. That's the thing where you answer some questions and they'll give you a fixed portfolio made up of various ETFs. There are already tons of commission-free brokerage apps that you can use, and many of them have recurring investment options. In terms of functionality, Beanstox is inferior to almost any other brokerage app because you can't even buy individual stocks. The only differentiator is the automated portfolio recommendations they give you if you pay $5 per month. Beanstox raised almost $3 million across 2 crowdfunding rounds, one in 2020 and the second in 2022. They did the second funding round on an equity crowdfunding platform called Start Engine. On the second funding round, the valuation offered to retail investors was $27 million. Beanstox tried to entice investors by claiming the simplicity of their app creates a huge opportunity. People who have never invested before could be attracted to the app's easy-to-understand functions. 100 million American households have no investment accounts. This is their total addressable market. However, if you look at the fine print, they disclose that this number is from 2013. Why did they use a statistic that is almost 10 years old? probably because the more recent statistics are far less favorable. With the rise of Robinhood and other commission-free brokerages, the percentage of Americans with investment accounts has skyrocketed over the past decade. As of 2022, there are only about 55 million American households without investment accounts. Beanstalk's main selling point is automated portfolio recommendations, which is also referred to as robo-advisory. There are already established apps which do exactly this. Some robo-advisors like Betterment and Wealthfront have large investment minimums, so they're only suitable for wealthy people. Others like Acorns and Stash are geared towards lower-income Americans. According to Beanstalk's, middle-income Americans are left out, but they give zero evidence to show why Beanstalk's is better for middle-income Americans. If we compare Beanstalk's to Acorn, Acorn seems to be superior in every single way. Acorn's cheapest plan is $3 per month. It includes expert-built diversified portfolios, the ability to do recurring deposits, ability to round up your purchases to the nearest dollar to invest the change, and tax-advantaged retirement accounts. At $5 per month, Beanstalk's is more expensive and has less functionality. It only has expert-built portfolios. It doesn't have round-ups or retirement accounts. With Kevin O'Leary being the public face of the company, Beanstalk's claim this gave them a huge advantage in marketing. As of March 2022, they had 13,000 approved accounts, of which 1,400 were subscribed to the premium subscription for $5 per month. Only 11% of the approved accounts end up paying the $5 per month. The remaining 89% of accounts generate negligible, if any, revenue. Under regulation crowdfunding, Beanstalk's has to provide some very basic financial disclosure. The most recent financials we have is for 2022. They generated $58,000, a 36% drop from the $91,000 they generated in 2021. Remember, this company was valued at $27 million on Start Engine, despite generating less than $100,000 in revenue. Their net loss exploded from $1.6 million in 2021 to $2.4 million in 2022. At $5 per month, they generate $60 per year per paying client. Based on their $58,000 of revenue, we can calculate they had less than 1,000 paying customers on average throughout the year. As of March 2022, they claim to have 1,400 paying subscribers. Based on how minuscule their full year revenue was, their number of paying customers almost certainly decreased dramatically over the remainder of the year. Beanstalk's is a complete and total failure of a business. They have minuscule revenue which is declining as their losses are exploding. In addition to using Start Engine to raise money for Beanstalk's, O'Leary is a paid spokesman for Start Engine. He signed a 5-year deal where they'll pay him $2 million plus options in exchange for a spokesman and marketing service. Crowdfunding platforms like Start Engine charge a commission every time you invest in a startup. That's why they're willing to pay Kevin O'Leary so much. With his reputation as a Shark Tank host, he lends credibility to their platform. This is despite the fact that his Beanstalk's company was such a disaster. I spent a few hours looking through listings of startups on various equity crowdfunding platforms. Almost all of them have immaterial revenue and absurd valuations. One of the most ridiculous listings I found was a company called Carbon Counts on a platform called WeFunder. It raised $5.7 million at a $28 million valuation. They developed a mobile game called Everforest. If you play enough of the game, the company claims it will plant a real tree in Kenya. It's currently operating in beta mode. They plan to launch it broadly sometime in 2024. On their offering page, they have a video of the company's co-founders talking about the prospects of the game.
The potential for returns is 10x, 20x returns.
You also can't guarantee that.
No, that is true. That is true.
But this is a business that actually has the kind of profitability that can deliver those kinds of returns. There are many mobile games and mobile gaming companies that are worth hundreds of millions of dollars or billions of dollars.
One of the co-founders is talking about 10x or 20x returns for investors. They hedge by having their other guys say they can't guarantee this. But the idea that they would even say this in a pre-recorded promotional video is insane. Remember, the valuation in their crowdfunding round is $28 million. So he's saying that this company could be worth $280 million or even $560 million. They haven't even launched the game yet, and the company only has 26 employees. They also talk about how some mobile gaming companies are worth hundreds of millions or even billions of dollars. That would be like me opening up an independent fast food restaurant and saying that you should invest with me because McDonald's is worth $200 billion. It's laughable. Yet somehow they convinced 122 investors to invest $5.7 million. The average returns of crowdfunding is very difficult to estimate because the secondary markets tend to be illiquid and thinly traded. If you buy a stake in one of these startups, it may be difficult to sell your shares until a company IPOs. Yet IPOs of crowdfunding companies are very rare. I could only find one example. A company called Nightscope makes autonomous security robots. They started raising money through crowdfunding in 2017. They went public by merging with a SPAC in 2022. Their share price has lost 97% of its value, and the company appears to be on the brink of bankruptcy. While equity crowdfunding might sound like an exciting proposition, it's important to be wary of the risks involved. Know that entrepreneurs will say just about anything they think you want to hear to get their hands on your money. Alright guys, that wraps it up for this video. What do you think about crowdfunding? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.